Happy New Year. I'm Steve Balch, the Director of Wealth Management and Financial Planning at Certa Financial Planning, here to give you our monthly market update for January. Our macro stance stayed the same to start the year. Santa did not visit this December as the S&P 500 decreased by 2.5% and the Dow Jones Industrial Average lost over 5%. The Dow even experienced a historic 10-day losing streak, the longest since 1978. The only bright spot was the Nasdaq, which eked out a small gain to an all-time high. Despite the negative month, the market trend remains positive. The Fed policy continues to be positive, but expectations of cuts for 2025 have decreased from 4 to 2. Additionally, with inflation continuing to be sticky, there are whispers about potential hikes returning. Nevertheless, the aggressive easing policy we saw to end 2024 is coming to an end, and the Fed will be much more data dependent in 2025. Fiscal policy continues to remain positive as the federal deficit was 6.2% of GDP in 2024. The estimate for 2025 is 6.3% of GDP. Leading economic indicators remain neutral as data appears to be in a Goldilocks range. November's jobs report beat expectations, and October's report was revised upwards by 36,000. The data was interpreted as just right upon the release, neither too hot or too cold, as many are viewing economic growth without the risk of overheating. Valuations continue to be neutral, even as U.S. market valuations hover around all-time highs. Nevertheless, earnings and earnings expectations continue to drive the U.S. market forward for now. The market regime stays in the reflationary quadrant. This still provides us with a risk-on environment. As a reminder, the regime occurs when inflation is rising while economic growth continues to be positive. The business cycle continues to be mixed as recession risks continue to be pushed off, but headlines persist. Risk of policy mistakes by the new administration or the Fed are main drivers of concerns. The three questions we're watching. Do market price targets mean anything? Is inflation becoming an issue again? Are valuations becoming an issue? Last year, the average year-end price target for Wall Street strategists for the S&P 500 was 4,861. The S&P 500 finished at just over 5,900 in 2024. This was more than 500 points above the highest estimate. As we start the new year, you'll see many predictions and headlines about the market. Remember, most predictions are just noise. After back-to-back 20% plus gains in the markets, many of these firms have no idea what the market will return. The goal is not to predict a return. The goal is to build a plan for you and stay invested. Is inflation becoming an issue again? All signs are pointing to rising inflation in the U.S. again. The CPI increased 2.7% year over year in November and is expected to increase again in December. The Cleveland Fed's current estimate is 2.86%. Core inflation, the Fed's preferred measure of inflation, increased 3.3% year over year in November. The Cleveland Fed's current estimate is 3.28% for December and 3.18% for January, well above the 2% target of the Fed. Producer prices also increased 3% year over year, the highest reading since February 2023. The uptick was driven mostly by food. As of this video, true inflation's real-time U.S. inflation gauge is 2.85%, down from 3% in mid-December, but still above the 2% target the Fed has and slowly creeping up since mid-September. Are valuations becoming an issue? Fixed income markets are warning that the stock market is the most overvalued versus fixed income and treasuries in almost 2 decades. Since 2000, when the yield on equities has been lower than that on bonds, it tends to spell trouble for the stock market. Currently, the S&P 500 earnings yield of 3.7% is the lowest compared with treasuries since 2002 and the lowest since 2008 versus BBB rated corporate bonds. Over the last 2 decades, a negative read has only occurred when the economy has experienced a bubble or soaring credit risk. So far, the valuations have not stopped this rally, and it's possible treasury yields continue to climb, reversing the negative reading. For now, it's something we're watching as stretched valuations and rising inflation worries create a potential headwind. our position and outlook. As we start the new year, we continue to be cautiously optimistic. We are headed into a quarter that historically has underperformed, and the markets are extended, but the overall uptrend continues. After a year that did not see a double-digit pullback, it is very possible a more normal year of volatility returns in 2025. For now, we continue to monitor and adjust as needed. If you have any questions, please feel free to reach out. Please feel free to forward this to anyone you believe can benefit. And as always, have a wonderful day.